there, everybody. It's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Happy Friday, everybody. Hope you guys are doing fantastic. Well, interest rates finished the week slightly worse than where they ended last week. Now, we've had a good run up in terms of the price of mortgage-backed securities, which brings the interest rates down, brings the yield down, and so that causes a positive impact to interest rates. And we've seen that happen over the last couple of weeks. This week took a little bit of a breather, and things finished the week worse than where they ended last week. It wasn't a real big movement, nothing that I'm massively concerned about right now. As we've talked about, it's always great to take advantage of these opportunities when they arise. And that's what we were doing with our clients last week. But we did see a bit of a pullback here this week, and we'll let you know how things continue in the weeks to come, as we always do. But there was not a whole lot of economic data that was released into the market, but the data that was released is kind of important from an overall interest rate perspective because it was about inflation. We saw the producer price index come in, and that came in showing a little bit hotter inflation than what the market was expecting. The month-over-month number came in up 0.3%. The year-over-year number came in up 0.2%. Expectations were for the month-over-month number only to increase about 1%, and for the year-over-year number to remain about unchanged. So it was a little bit hotter on the producer side. Different story on the consumer side. Consumer price index came in showing a decline of actually 0.1%. Market was expecting it to be zero, so it was a little bit worse than what the market expected. And the year-over-year number came in unchanged from the previous month. Market was expecting a slight increase to that. That didn't happen. So it's showing that there's maybe some inflation pressure on the producer side. Not so much right now, at least on the consumer side, which was generally good for interest rates. But interest rates did get a little bit worse, as I had mentioned, primarily due to all of this trade talk, trade wars that are going on between the United States and China. So that did cause some pressure for interest rates. But one thing I did want to talk about here this week is something that is going to be important probably in the months to come if this trend continues, and that's the relationship between the 10-year yield and the 2-year yield. Because if once there is an inverted yield curve, that's probably one of the biggest indicators that a recession may be in the not too distant future. Usually takes about 12 to 18 months to actually materialize, but an inverted yield curve is one of the best indicators of a potential recession, and we are seeing that yield curve continue to get lower. And let me show you what this looks like here. So right here is the 10-year Treasury yield minus the 2-year Treasury yield. You can see when it turns red here, that is what's called the inverted yield curve. These gray bars here are recession. So inverted yield curve, 12 to 18 months later, recession. Inverted yield curve, recession. Inverted yield curve, recession. And this pattern continues. Now, our last recession was almost 10 years ago, and we're at the absolute lowest level since that time. If we take a look at 1 year here, you can see that this yield curve is going down, which is natural because the Federal Reserve has been increasing short-term rates, and when the short-term rates go up, that causes the 2-year yield to go up. And as short-term rates are increasing, that has a drag on the economy and can cause the longer-term rates to either stay the same or maybe even go down. And so we're at one of the lowest levels here over the last 10 years. You can see this is when our last recession was. And, here it's been coming down. And then we're back to the max here, so you can kind of see, again, 12 to 18 months recession. So it's something to keep an eye on. It's something that if this gets lower and lower and actually inverts, you're going to hear a lot about. So I want to make sure that we're paying attention to it and we can let you know what's going on, so that way you can talk to your consumers about it as well. So if you have any questions, please give me a call. That's what's going on with economic data here this week. Next week, it is a big week. We're going to see a lot of numbers from the housing sector, and we'll keep you informed with what's going on there. And again, all of this geopolitical talk with these trade wars, that's going to have a big effect on interest rates, as well as the volatility in the market that's just already naturally there. We'll keep you informed. If you have any questions, please give us a call. Thanks for joining me with Java with Jared, and we'll talk to you soon. Bye-bye.